Welcome back. Today we're talking about a powerful strategy to grow your wealth, and the best part is it's surprisingly simple. This is all about spending less time staring at stock charts and more time, actually living. Let's dive in.
So here's the game plan. We'll start with why most people, even the pros, don't beat the market. Then we'll get into the core idea, the actual tools you'll need, and a couple of simple rules. We'll also bust a common myth and wrap up with your absolute strongest ally in all of this.
Okay, let's just get right into it. And we're going to start with a question that, let's be honest, has probably kept a few of us up at night.
And it's this. Why is it so hard to beat the market? I mean, even the pros struggle with it. Seriously, the data is pretty wild. Something like 80% of active fund managers, these are the folks getting paid the big bucks to pick stocks, they don't beat their own benchmark index. So yeah, if you've ever looked at your portfolio and felt a little disappointed, you are definitely not alone.
So what are we supposed to do? If the pros can't win, what chance do we have? Well, here's the thing. The answer isn't to try harder. It's not about finding that one magic stock. It's about changing the game entirely.
And this is it, the big idea. Invest actively in your life and passively in the market. Think about it. Your time, your energy, your creativity, that's your real gold. So instead of pouring all that into the crazy, unpredictable game of stock picking, you pour it into things you can actually control. Your career, learning a new skill, starting that side project. You focus on making more money, and you let the market do the slow, steady work of growing it for you.
Okay, that sounds great in theory, right? But how do you actually do it? How do you passively invest in the market? Well, you're going to love how simple this is. Let's look at the tools.
So here it is. This is a classic setup called the Bogleheads 3-Fund Portfolio. The name might sound a little nerdy, but the concept is just genius in its simplicity. With just 3 ETFs, you basically own the whole world. You've got VTI, that's your engine, the entire US stock market. Then VXUS, which covers all the stocks outside the US for that global reach. And finally, BND, the US bond market, which is kind of like the steady, boring foundation of the whole thing. And that's it. You're done. You're diversified across assets and around the globe.
But wait, what if even 3 funds sounds like too much work? No problem. You can simplify it even more. You can just combine the first 2, VTI and VXUS, into one single ETF, VT. That's the Total World Stock ETF. So now your entire global diversified portfolio is just 2 funds, VT for all the stocks in the world and BND for bonds. It literally cannot get any simpler.
Okay, so you've got the tools. That's awesome. But the tools are only half the story. The real secret sauce here is the discipline. But don't worry, it's not complicated. We're talking about just 2 simple rules you need to follow.
First up, how do you know how much risk to take, and how does that change over time? Well, there's a super simple guideline for this. It's called the birthday rule, and it basically automates the process of getting more conservative with your money as you get older. It's brilliant.
Here's how it works. Ready? Your age is the percentage you should have in bonds. That's it. So if you're 30, you put 30% in bonds. That's your BND fund. The other 70% goes into stocks, like VT. Next year, when you're 31, you guessed it, 31% in bonds. It's an automatic set-it-and-forget-it way to dial down the risk as you cruise towards retirement.
All right, rule number 2, rebalancing. Here's the deal. Throughout the year, your investments are going to grow at different rates. So that perfect 70-30 split you started with, it's going to drift. Maybe stocks have an amazing year, and suddenly your portfolio is 80% stocks. All you do is, once a year, just once, you log in, sell a little bit of what went up, and use that money to buy more of what went down, bringing you back to your target. It's an incredibly powerful, unemotional way to force yourself to buy low and sell high.
Okay, time to tackle the big question, the one I know you're thinking about. The US stock market has been an absolute beast for the last decade plus. So, why on earth should we bother with international stocks? Is going global really necessary? Let's dig in.
So when you look at VT versus VTI, you're really looking at 2 different bets. With VT, you're betting on the whole world. You're saying, I don't know where the next big growth story will come from, so I want a piece of everything. With VTI, you're betting that America's dominance will continue, and that big US companies like Apple and Coca-Cola already give you plenty of international business. There's no crystal ball here, but we can look at the past.
And yeah, if you just look at the last 10 years, the scoreboard is pretty clear. Sticking with just the US market, VTI, has given you much better returns than the world market, VT. No question about it.
But we've all heard the warning, right? Past performance is no guarantee of future results. And it's true. If you look at just the last year, things have started to shift. The global market has actually started to pull ahead. It's just a classic reminder that things run in cycles. The winner of the 2010s might not be the winner of the 2020s.
Okay, so maybe the performance crown will get passed around. But what about safety? What about diversification? The whole reason to go global is to protect yourself when things go bad, right? If the US market crashes, your international stocks should cushion the fall, shouldn't they?
Well, you might want to sit down for this. Looking back at the big crashes, like the 2008 financial crisis and the 2020 COVID crash, the global fund actually dropped a tiny bit more than the US fund. Kind of blows your mind, right? The reason is that today's economy is so interconnected. When the US sneezes, the whole world catches a cold. In a panic, everything falls together.
So, if it doesn't always perform better and it doesn't really protect you in a crash, then why the heck would anyone choose the global fund? Well, for a lot of people, it comes down to two things: true diversification and cost. I mean, the cost is just insane. For an expense ratio of 0.06%, you're talking pennies. For that tiny fee, you get to own the entire world stock market. It's the ultimate, I don't know what's going to happen, so I'll just bet on everything move.
So we've looked at the ETFs, the rules, the whole VT versus VTI debate, but at the end of the day, the thing that will make or break your success with this, it has nothing to do with which ticker symbol you pick. It's something way, way more important.
Because here's the truth. You don't get rich by trying to be a genius, by jumping in and out and timing everything perfectly. No one can do that consistently. You get rich by just being there, by being in the market year after year, just soaking up the long-term growth of the economy. It's not about timing the market, it really is about time in the market.
And that's because your greatest ally in this whole game is time. Time allows the miracle of compounding to work. It's that snowball effect, right? Your money makes money, and then that money starts making its own money. It's a slow process at first, but over decades, it becomes an unstoppable force.
Which brings me to my last question for you. And this one really ties everything we've talked about together.
So what's the single best investment you can make right now? It's you. It's your career. By making your investing simple, automatic, and passive, you get back your most precious asset, your own time and brainpower. And you can take that time and invest it where it gets the highest return, in yourself. You go out and actively build your career, your business, your life, while your money works passively for you in the background. That right there is how you build real wealth.